Hi, I'm Zach Gutchis, founder and lead financial planner at True Riches Financial Planning. In today's illustrative video, we're exploring how I partner with clients to help them evaluate any potential or existing investment real estate properties that they have, and if that property is producing sufficient returns to justify its illiquidity, plus the time, energy, and effort that it takes to maintain a rental property as compared to a more simple, liquid, diversified investment portfolio. We'll also look at how I help quantify the tax impact of a 1031 exchange, a gift to charity, or if they want to outright sell the property and diversify the proceeds into a diversified investment portfolio. I hope you enjoyed the video. So we start with a checklist of basic information about the property, such as the rent, how much they bought it for initially, when they bought it, if any refinances were done. And then we'll also look at the tax profile of the couple specifically, and then also what the revenue and expense profile is for this specific property. So starting with the purchase date, this property was purchased in 2018 for $300,000. This is an actual townhome in Denver, Colorado. We think that the property has appreciated up to about 375. That's what it could be sold for today. And the property initially, when purchased, had a 20% down payment, so $60,000 as a down payment. The initial closing costs were $3,600, but then during COVID in July of 2020, this couple refinanced the property. So they did not do a cash out refinance. The cash out amount was zero, but the mortgage amount at that time had amortized down to about 225,000. They paid some closing costs for the refinance and were able to refinance at a 3% rate over a 30-year time horizon in July of 2020. And then by using the client's tax return, there's some important information such as passive activity losses, a capital loss carry forward. These can be obtained from tax loss harvesting in a brokerage account, for example, or selling investments at a loss. And then for this married couple, their gross household income is 350,000. So their marginal tax rates are this for both federal and state. And then their capital gains tax rate, if they were to sell, would be about 15%. And then we'll talk about how depreciation recapture works, which is a flat rate of 25% maximum, and how passive activity losses can help offset depreciation recapture. So again, this is a married filing jointly couple. They initially acquired the property in 2018 as a rental, so it was never used as their primary residence. And so for that, they do not get a capital gain exclusion amount like you would get if you were selling your primary residence. As mentioned previously, this townhome is rented for $1,600 per month, and we've assumed a vacancy expense of 4.2%, which is essentially half a month each year the property is not vacant, just accounting for tenant turnover over time. The HOA fees on this townhome are about $200 a month, so $2,400 annually. The homeowner's insurance is $1,400 for the year, and they pay a property manager 10% of the monthly rent. The average repairs for this property over the last 3 years have been $500 per year on average. The property taxes are about $200 a month, so $2,400, and the landlord paid utilities have been $750. After using all of the information from the checklist, we make some high-level assumptions for the property on a go-forward basis. The four assumptions are the annual increase in rent, the rate that property taxes will go up each year, the rate that expenses will go up each year, and how fast the property will appreciate each year. So using all of these checklist data and these assumptions, we can then project forward what the potential returns using the two primary metrics in residential real estate will be for this property. So after vacancy expense, the annual rent for this property is about $18,400. Then using all of those expenses that we just looked at on the previous page, the HOA, the insurance, the management fees quantified, right? 10% of the annual rent, the repairs, property taxes, and utilities that are paid by the landlord. So the total operating expenses are about $9,300. So annual rent of 18,400, take off expenses of 93. That's a net operating income or an NOI of about $9,100. We then have to look at a few other expenses. They do have a mortgage on this property, right? They refinanced at a 3% rate over 30 years. So first we're looking at taxable income. So this is what would flow through to a tax return, not necessarily the net cash flow of the property. We'll look at that in just a minute. So only the mortgage interest portion is deductible for tax purposes. You can see the principal portion of the mortgage payment down here, but again, you can't deduct that for tax purposes. So just the interest portion of the mortgage. And then depreciation, the IRS allows you to use depreciation, even though it's not a cash expense out of your pocket, but it can cover over the net income from the property for tax purposes. So the net operating income minus the interest on the mortgage and minus depreciation, it actually is generating a negative taxable income. So they're not paying any sort of tax on this property. Now, a passive activity loss is used when the taxable income is negative and the couple's income is too high that they can't use this loss to offset their income from their wages. So it gets carried forward over time as a passive activity loss, a PAL. So it gets added to the existing passive activity loss that they've had from previous years. And you can see that year over year, the 21 plus the 7, that's what goes in forward to next year, about 28,000 there. Now we're looking at, not from a tax perspective, but just a net cash flow perspective of this property. So we have the annual rent minus the operating expenses, minus the mortgage interest, and minus the mortgage principal. This property, from a true net cash flow perspective, they're losing about $2,300 per year. So they will have to supplement from either their excess cash flow or their savings or investments of about $2,300 just to keep this property in place, rented, and to pay all the expenses and the mortgage on the property. So the cash invested in the property is the original down payment of $60,000 plus any closing costs paid both originally when the mortgage was set up and the refinance that they did in 2020. So the total cash that they've invested into this property is $65,000. So the first metric that's really important to understand with residential investment real estate is your cash on cash return. So as you can see, this property is at a negative 3.5% cash on cash return for year one. But then what we can do is project out using all of these assumptions, looking forward each year up to 15 years. So as we look at going forward on a cash on cash return perspective, you can see how even with rent increases, property appreciation, and paying down more principal rather than interest on the mortgage, this property is cash flowing negative for 14 years. Only in year 15 does it finally barely turn positive, a net cash flow of $128 for the year. So that's not a great sign, because you're having to supplement your savings or your investments just to keep this property in effect. And we'll look at the second most important measure in just a second, which is ROE, or your return on equity. So the fair market value, what we think the property could be sold for today, is about $375,000. And the mortgage balance amortized at the end of 2025, the end of year one, would be about $207,000. And then assuming a 6% selling cost to pay the realtors, both on the buy and sell side, 6% of the fair market value, around $22,500. So the current net equity in the home is just shy of $145,000. Now notice there's no taxes being taken out here, and this is what would be eligible, the 145, if you were wanting to do a 1031 exchange if you don't like the performance of this property. So the equity in the home is the denominator in our return on equity metric, which is the second important metric with residential investment real estate. So when you're investing in real estate, there are three main elements of return. The first two, and it's really important to understand this, is what's the ratio of illiquid returns versus liquid returns. So the first is each time that you're paying the mortgage and you're paying down that loan balance over time, a portion of the payment is going to the principal. We saw that up here, the principal portion of the mortgage. And so you're increasing your net worth if you hold this property through the end of the year because You've decreased your loan balance. You've reduced a liability, so your net worth has increased by 5217 if you keep this property in place and pay the mortgage. So that's an element of return. The second piece is we looked at above the property assumption of 2.5% appreciation on an annual basis. So if it's at 375 and it appreciates by 2.5%, that's about $9,400 of property appreciation in year one. Now, again, both of these first two elements of return are not money in your pocket. They are not a true cash flow. They are increasing your net worth, but they are illiquid. You cannot just transform these returns into cash unless you were to fully liquidate the property and potentially, have taxes, which we'll look at in just a minute. So there is a good amount of return coming from the property, just about 14,500, but again, it's not money in your pocket today. It's all just on paper that your net worth is growing. Then, as we saw earlier, the property is cash flowing negative. So that's the final element of return. Is it could be positive down the road, but right now it's negative cash flow, the liquid portion. So you're having to come out of pocket $2,300 just to, maintain this property. So adding up all three of these, the total returns in year one for this property are projected to be around $12,300. So we divide our return by our equity in the property, and that gets us our return on equity. So for year one, expecting about an 8.5% return on equity. Not a bad number in a vacuum, right? That's a pretty decent return. But again, knowing with real estate, there's a lot of, downsides. There's, sweat equity and illiquidity and administrative tasks. And if you're going to sell the property, there's a lot of work you have to do in getting a loan. So is 8.5% in year one. And you can see the rolling returns going forward. Are these levels of return really worth all the additional hassle and administrative work and sweat equity that you have to do for this property? And honestly, the answer here, it depends by person, but probably not. And you can actually see for ROE how over time that ROE is actually decreasing over time. Now, the cash on cash return is getting less and less negative and finally switches positive, but your return on equity is getting smaller. And this is very common in investment real estate because the net equity in your home is growing each year, but at the same time, your returns are not keeping up with the level that your net equity is growing. So the numerator, the returns are growing slower than your denominator, the net equity is growing. And that's leading to diminishing return on equity returns over time. And this is the kind of the big problem we see with, having a property manager and having low maintenance properties like a townhome or a condo where the HOA fees are pretty high and they're dragging down the ultimate returns of the property. So for this property with this, Denver townhome, this was a potential sell scenario. So with the client, we wanted to determine, okay, what is the tax impact if we were to sell or do a 1031 exchange? And that's our final tab. And we can look at a year of sale, in year one, currently it's 2025, or all the way out for additional 15 years. Again, we've looked at some of this data before, but we think the property could sell for 375. You'd have to pay selling costs of 6%, so that's taking off about 22,500. So the amount realized by the seller would be just over 350. Recall they bought this townhome for 300,000 back in 2018. And then they've been depreciating the property, right, about 10,200 a year for the last 7 years. So there's accumulated depreciation. You've been getting tax benefits for that. So that actually reduces your cost basis in the property. So the total gain in the property is the difference between the amount realized by the seller and the adjusted cost basis, which is about 127,000. That's the total gain loss on the property. Now, the depreciation portion has to get recaptured. The IRS has been giving you tax breaks every year, and so they want their money back. So we subtract the total gain loss by the depreciation amount, the accumulated depreciation, and this amount is going to get taxed at a special rate called depreciation recapture tax. Then the residual of that, the 127 minus the 76, is what's our net capital gain. That's about $51,000. Now, this can be offset by capital loss carryforwards. In other words, if you'd sold investments at a loss or you've done tax loss harvesting in the past, you can offset this 51,000 with a portion of those capital losses. If you had a $51,060 capital loss carry forward, you could offset this entire capital gain that you would have from this property. This client only has, in this example, 5,000. So the difference between those 46,000 would be subject to capital gains tax, which for this client making 350,000 of gross household income is a tax rate of 19.4%. So the total taxes for capital gains just under $9,000. Here's that depreciation recapture amount. Now, remember earlier, they weren't able to use the full effects of depreciation in past years because they couldn't use the taxable losses from the property to offset their income, so they got to carry those forward. So the portion that they got to carry forward can offset depreciation recapture. So the net taxable depreciation recapture is 48,000. In this couple's case, their depreciation recapture rate is 28.4 between federal and state. So total taxes of just under 14 for that element of tax. Then last but not least, there's a net investment income tax that would apply here too, because again, the client's income is too high and they're generating a capital gain and depreciation recapture with this sale. So the net tax would be about 3,600. So when we look at all three elements of taxes that we'd have to pay, the total taxes owed if we were to sell this property at 375,000 and at the end of 2025 would be just over $26,000. So then understanding what would be coming into the portfolio, the amount realized, right, the 375 minus the selling cost, that's the 352,000 here, minus they'd have to pay off the mortgage if they were to sell it, minus the taxes. So what would be coming into a diversified portfolio would be about just over $118,000 from selling this property. As you can see, there's a lot that goes into being able to reasonably project the forward-looking performance of your rental property and if those are the most optimal use of those investment dollars for you. Real estate and taxes are also intricately connected at the hip, so it's paramount to be able to quantify the tax impact of a disposition, whether it's a 1031 exchange, gifting to charity, or a full disposition and paying the taxes and diversifying the investment proceeds. So if you're wanting a certified financial planner and CPA to help you integrate your existing investment residential real estate in your overall financial plan and make sure your investments are giving you the best chance at achieving your specific life goals, get in touch by scheduling a complimentary discovery meeting at truerichesfp.com/contact.